Hello, everyone. Welcome to the first quarter 2021 investment market review. My name is Bob Dunn, president of Novi Wealth Partners. Today, I will be joined by Mario Nardone, our chief investment consultant. Each quarter, we create content that is relevant to all investors and based on science, not speculation. We intend to provide knowledge and guidance, not sensationalized forecasts on future investment outcomes. As fiduciary advisors, our primary goal is to do what is in your best interest. You will not find us chasing the hot stocks or pretending that we know the future. In place of the traditional investment entertainment, we intend to make sense of what is going on today in the investment world and what that means to you. Today, Mario will look at what has happened in the investment world during this past quarter, as well as provide some education and context to what is consuming most of the investment headlines today. I look forward to what you have for us, Mario. So let's hear it.
All right. Thanks, Bob. Always a pleasure to be here. Appreciate the opportunity. Here we are, first quarter of 2021. This COVID crisis has been with us a full year now. And, we can acknowledge that, as we think about investment markets, we're going to talk about some positive developments, but COVID is, very much still dominating our way of life. Dominating the economy, our financial markets. And while, as we go through this presentation, you'll get the sense that, at least personally, I do get a sense of optimism every time I read or hear the term post-COVID. But then there's that little part of me that is hoping that that's not jinxing it. So as always, we do want to take a balanced approach. I'm sure you do too. But I don't know, at least for me, it feels like we're swaying a little bit more towards the optimist view. So as always, go ahead, Bob.
Yeah, I was going to say I agree on that, but I agree on both points that, starting out what we say here in the intro is we can't predict the future. But, if you want to go from a perspective to just say, even if just in life, things are feeling good. People are getting their shots. You're seeing them posting up all over the place. And that was the part of the catalyst for the economy transitioning and changing to what it has been for the past, little over a year now. So we're getting back towards where hopefully people can get back to normalcy. So agreed.
Exactly. So let's start off the way we always do, which is really to take that balanced approach, showing the reasons for optimism and reasons for not concern, but maybe uncertainty. As you mentioned, as you see on the left side of the page, vaccination efforts have been accelerating. Economists, getting back to the point where vaccines were even just being approved, we started seeing that optimism start flowing into economic outlook, market perceptions, consumer behavior, and that sort of thing. Second bullet point on the left side, we had a Federal Reserve that was dedicated to creating policy that was set to get our economy going or keep it going in that trajectory. And we also can't ignore the $1.9 trillion government stimulus that we received that's also feeding that optimism. And again, the output of that, if you will, or a fall-on effect is that consumer confidence is growing. On the right side, we see those reasons for caution. While here in the US, we all are seeing people posting their pictures with their vaccine cards and that sort of thing. And that is, a great thing for our economy. But as we'll talk about in a very few short seconds here, that isn't necessarily the case globally. So it's a little bit of an inconsistent vaccine rollout. Also, if all of this government stimulus really does put us on sound footing, the specter of inflation is starting to kick up again. And if that actually does materialize, that could put a damper on the depth and breadth of the recovery. And then certainly the last bullet point there on the right is that it's about the unknowns, the things that are lurking out there that might come up, whether it's geopolitical or what have you. Anything can derail this turnaround in our economy. So we need to be cognizant of that. So I mentioned, the vaccine being not quite so globally coordinated. This slide, really paints that picture very well. And keep in mind, some of this data looks old. This was all put together as of the quarter end, about 2 weeks old, but it still tells the story. So we acknowledge that this crisis that we're in, this economic crisis, is really a health crisis at its core. And because we live in such a globally interconnected world, especially economically, we feel it makes sense to look at how the health crisis is being handled across the globe. So as you can see here, in terms of the pace of vaccination, there have been some wide discrepancies among countries. You have Israel at 60% of its population being having at least one dose of the vaccine as of April 1st. And then look at the bottom with Japan, a developed economy that's so important for the global, or a developed country that's so important for the global economy, with almost no vaccinations being rolled out. And then right in the middle, despite feeling so optimistic about how things are shaping up here in the US, we're right on pace with Bahrain. And I have to admit, Bob, I didn't know where Bahrain was until I started getting into Formula One racing a few weeks ago. So, that's just tells you where we are and where the world is in this effort.
Yeah. I think Japan's got a universal healthcare system as well. So
I honestly don't know what their issue is. I didn't dig into that, but I was surprised to see that they are making so little progress.
Yeah.
All right. So I want to take a moment to look at the headline of this page. And certainly the headline itself might seem like a negative, but it's really rooted in good news. With the vaccines rolling out and continued monetary and fiscal stimulus that we talked about earlier, investors may be expecting that dose of inflation, which makes the low yields on treasury bonds less attractive. So what you're looking at here is the rate of change in treasury prices on a year-over-year basis. So an uptick in the graph means treasury prices went up, and a down slope in the graph means treasury prices have come down. So if you think about an economy that's opening back up with a lot of stimulus in our future, then another component of this is that investors are more likely to turn towards more risky assets to capitalize on an uptick in the economy and potentially in risky asset prices. So if you look at the far right side of this graph, you see that there has been an abrupt turnaround in treasury prices. The peak at the far right, at the beginning of that gray bar that represents recession, you'll see that indicates that around this time last year, treasuries were up 10% year over year. And if you think about what was happening then, there was a flight to quality and a flight away from risky assets. So it made sense that treasury prices were bid up. And then the most recent reading, taken on March 26th, says that treasuries were down about 3.8% year over year. So a reversal of that fear that we had a year ago, now encouraging investors to move out of risk-free or less risky assets like treasuries. One of the best ways to understand what's going on in the bond market, and a slide that we tend to include every quarter, is to look at the treasury yield curve. The yield curve reflects the rate of return or yield on treasury bonds of various maturities. And it looks like the scale was erased this time around on this slide, but I can tell you that the blue line in the middle is the most recent reading, and that 1.74% is the 10-year treasury. So to the left of that, you have shorter term bonds, and to the right of that, you have longer term bonds. The shaded area, which is different way to present it from in previous quarters, shows us the minimum and maximum yields over the past 10 years. So if you look at the bottom graph, the bottom curve, you see that was the low point of the most recent 10-year period, and that was just achieved on August 4th of 2020. So again, it's no surprise that with such an increase in monetary and fiscal stimulus, as well as a rollout, or approval and rollout of the vaccine, that all of those things together are lifting investors' spirits. And that sell-off in treasuries has the result of rising or raising their yields on a going forward basis. The one segment of this yield curve that hasn't really changed since August, or really since last March, is the very short end of the curve at the far left. And that makes sense because it's that part of the curve that's controlled by the Federal Reserve. Federal Reserve has signaled that they plan to keep their rates near zero through 2023 to keep the economy back on track. So what this is really reflecting in terms of sentiment is that bond investors expect the Fed to hold to their word of keeping short-term rates low, but that those short-term rates and other policy is going to work and is going to have the impact of rising asset prices, potentially raising inflation. And that's why longer portions of the yield curve have picked up in yield and what we call a yield curve steepening. Now, if we look at the recent returns on bonds, the left and middle section of this page both show the first quarter returns. The expectations of a strengthening economy and thus potentially better returns from riskier assets have led to that sell-off of some bond segments. And this is how you translate what we've already talked about two other ways into the rate of return of our bond portfolio. Yeah. So you see it in these two sections, we have the majority of bond segments are negative, some of them are flat, and the one notable exception is inflation-protected bonds, or TIPS, Treasury Inflation Protected Securities. So I've mentioned it a number of times already that it stands to reason that all this government stimulus and a rebounding economy has led investors bidding up the prices of these bonds. The right side of the graph shows the full year ending 3/31. Again, not surprising. The riskier segments, and I use that term loosely, like corporate bonds and even to an extent municipal bonds, have rebounded quite a bit over the last year from that fearful period of a year ago. That flight to quality we saw last year in treasuries has reversed. And that's why we see negative returns for short and intermediate term treasuries. That's the minus 0.1 and minus 4.2 on the chart.
Yeah, I want to take one moment on that, Mario. It just came to mind as I'm looking at this again, is the fact that we've had some situations where people have come to us after some severe volatility in the markets, where they rode the market down, they sold their positions and bought an asset such as a U.S. Treasury because it was going up during the time the stocks were going down. And just an experience here, 12 months later, the asset that they likely or could have purchased into, the U.S. Treasury at 5 to 10 years, could then be down again. So, talking about moving your money around, trying to time or predict, what asset class is going to be most appropriate next, is not a good recipe for success. You think treasuries are the safe haven, and as a stable piece of your portfolio on an ongoing basis, it's an important component. But to move in and out of that or any other asset based on what we prognosticate the future will look like is typically a losing scenario. So
yeah, absolutely. The analogy that comes to mind based on what you said is, if you're doing a high wire act, a safety net is always a good idea. You don't go try to find your safety net when you're falling off the line, right?
Very good analogy, yeah.
You want to have those treasury bonds in your portfolio all the time. Yeah. And that's a great segue, Bob, because the next slide is all about, folks that want to or attempted to try to predict what's going to happen and what assets will outperform. And in particular, we talked about inflation being a talking point right now. So investors are starting to ask the question, well, okay, we haven't had inflation in 30 years. So we know what our portfolios have looked like over that period, but do we need to do something different now that inflation is coming? And what this chart does is it shows you what asset class returns look like in various inflation environments since 1988. And first thing we want to do is say we're not predicting we're not going to try to predict which of these environments are going to occur. We just want to show the facts as they have played out. But in terms of inflation, what we do know is that we're currently in an era of low inflation. So if somebody is, worried or has that belief that inflation is rising, then we would be looking at the bottom left quadrant in what we would expect to be seeing, a low and rising inflation scenario. And the 4 times this has happened since 1988, you can see it's generally been good for most assets. So again, Bob, no sense shifting your portfolio, just keep owning the diversified mix that you have and not worry about inflation, really taking too much of a toll. The sole exception here is cash, right? Inflation has the biggest impact on your cash holdings because it makes that cash less valuable. You have less purchasing power going forward. The real takeaway, though, is that the same can be said for all other environments, right? Yes, there might be distinctions between emerging market returns in a low and rising or versus a high and rising inflation environment. But if you look across this page, everything is generally positive in every environment. So what's the use of trying to make any prediction? Just maintain that diversified portfolio that you already have. Now, some of you, eagle eyes are looking across the page and you do see that the one negative on the page is commodities in a low and falling inflation environment. And I think it's safe to say that the majority of our portfolios don't have meaningful exposure to commodities anyway. It's not really a big component of our investment strategy. But if anybody wants to talk about commodities, we can certainly do so.
Yeah, I just want to touch on that real quick. Our research has shown in our time participating in commodities is that it's a very volatile and expensive way to protect against inflation. So, at one point it was an asset that you could participate in if there's fears of rising inflation. But if that does not come to fruition, then you've participated in an asset that's been very expensive and volatile to try and thwart any potential inflation coming up on the horizon.
Yeah, we would agree with that.
Mhm.
So again, how many times did we mention the word inflation? One more time on this slide, what we want to point out is an interesting thing about the inflation measure itself. And also in particular that we want to be careful not to make too much of any single measure or metric in the investment and market media. When we think about inflation, the most often cited measure is year-over-year change in CPI, the Consumer Price Index. And when you consider that CPI actually dropped a year ago, which is the section that's circled there, then even getting back to normal trend price increases is going to look like a significant uptick in inflation. So it really, even if we get a higher inflation rate, it really just means we're getting back on track to where we were. And we know that the Fed understands this, right? So if they see a 3.5%, 4% inflation, they're not going to hit the panic button. But what we hope is that investors, and in particular institutional investors that really have the potential to move markets in most cases, don't get unnecessarily spooked if these calculations do spike. Now, turning our attention to stock market returns, the 12-month returns shown on the right are really something to look at. Granted, this is coming off the major sell-off of a year ago, but if we just transport ourselves back to that period, I don't know of anybody that would have had expectations that we would see returns close to 100% for any component of the stock market. And you have to also point out that those 12-month returns really distort the scale of this graph, and it obscures the divergence among US stock categories for the first quarter. Again, the left side of the page represents the first quarter of this year. I mean, that first tick hash mark is 20%.
Yeah.
Right? So it looks like everything is sort of doing okay. But when you really look at the divergence between, say, large cap growth, which had been the dominant performer in the past 5 to 10 years, only up 0.9% for the quarter versus small cap value, the dark blue line being up 21.2%. On a typical scale, that would be a monumental difference. So we need to definitely acknowledge this reversal in leadership. And I believe that you alluded to this earlier, and that is that the change really started happening around November when vaccines started to gain approval. And how this plays out is that the large cap growth companies that had been doing well were mostly the tech companies that really weren't negatively impacted by a stay-at-home economy. More people watching Netflix, using Facebook, all that, buying their goods and groceries on Amazon. But with a rollout of a vaccine, then you can start seeing traditional cyclical companies and sectors start to do better, start to get back to business. And those kinds of companies are more prevalent in the value side of the equation and more prevalent in smaller company stocks. And that's why we've seen some of that reversal.
Yeah, Mario, I said I wasn't going to, before we started, I said I wasn't going to chime in too much, but something else that came to mind as I look at this slide again is that, I want to thank our clients because we do take tilt towards small cap stocks and value stocks. And, we also, there was a saying in the past where we want to avoid any major surprises. Well, small and value, like you alluded to, or let's put it the other way, large and growth have outperformed for quite some time. And our clients have been have listened to our guidance and our advice. And because of that, we're able to participate in this recovery of small cap. There was a few people that got a little anxious and wanted to change, and through some good conversation and demonstration, they were able to sit tight and stay with the investment plan that had been laid out. And by sticking with the investment plan when it's uncomfortable, these are the types of results that you can hope to see post any kind of big market moves, or when it's an asset class is out of favor. So I just want to thank our clients for taking our guidance and listening to us and being able to stick with the asset class and being able to appreciate these types of returns.
That's what it's all about. That's a great testament to the fortitude of your clients and the education you provide. So diving a little bit deeper into that reversal in sector leadership, we kind of alluded to that in the context of large growth, small value, and that sort of thing. But what we're looking at here is a deeper dive into the actual sectors. And it looks at the period from the beginning of 2020 through early November when the vaccines were first approved, and then compares it to the period since. So clearly, the top part of the page shows you the sectors that were hit hardest by shutdowns, right? Energy, airlines, we know airlines came almost to a complete halt, right? So then, as the promise of the vaccine emerged, these sectors that had thrived, such as online retail at the bottom, again, going back to Amazon, had most of the wind taken out of its sails. Now, I think that Amazon will continue to thrive. I know, their trucks come into my driveway almost every day, and probably will continue to do that because we learned we could shop a different way and don't have to fight traffic and that sort of thing. So it's not that Amazon will now fail, but we certainly can see that other types of sectors and other ways of people to spend their money has emerged since the vaccine, and that has lifted their stock prices. Similarly, there has been a bit of concern, or at least questions, over real estate investments. We don't often talk in detail about the REITs in our portfolio, REIT, Real Estate Investment Trust, but this is a good opportunity, and this is a great slide to actually get in the weeds a little bit. So in particular, we do hear questions about whether people will return to office buildings or go to shopping malls ever again. And as I mentioned, while the world will undoubtedly be different post-COVID, if there truly is a post-COVID era, we still think fears over the REIT sector are a little bit overblown. As this graph shows, only around 38%, which is the light blue section, of equity REITs are actually negatively impacted by social distancing. And when you consider that many of these impacts may be temporary, and or maybe even they come back stronger like we saw with other stock sectors, we certainly would not advocate for a wholesale bailing out of the REIT category. So on the topic of making predictions, what better lesson in humility than Final Four bracket? If you're like me, you've agonized over picking your matchups, and once it's done, you have that confidence that you had picked the right matchups, you picked the right upsets, but all it takes is Abilene Christian to beat Texas, and your bracket is busted. Statistically speaking, ESPN.com reported that only 108 of the 14.7 million brackets that were submitted were correct through just the first half of the first round. And we think trying to pick stocks or pick star managers or time the market is just as tough to do consistently.
Yeah, so if that's your talking points, I just want to anecdotally talk about what transpired in our office. We do have a number of basketball fans. I enjoy watching it, but I don't have the knowledge that others would have. And the person with the least amount of knowledge won last year and came in second and missed by a very small margin of winning it. And this person that came in second was the only person to pick Baylor to win. And their methodology to pick the teams is to compare their perceived food offerings for the town that the university resides from. So, how we go about picking assets, hopefully we're a little more diligent than using food choices. But it just goes to show that expertise or this perceived notion that you can predict what asset or when to buy that asset is going to be a productive outcome. That's not typically the case. So I just thought it was interesting that Candace, the person that got second, is not interested in sports at all.
That's great. Yeah. I love that. It's coming to mind. I'm thinking about international cuisines. I wonder if that same logic would help in the Olympics.
Oh, that's a good call. We'll have to see how that works.
Have to try that out. So, all right. So continuing the conversation about the stock markets, now we're looking at non-US, talking about international, right? So this is ex-US stock markets, and you see that the pattern is the same as in the US, but the magnitude is different. Right, much stronger returns for the 12 months, but instead of 90 or 100% returns, we saw returns in the 40 to 60%. For the first quarter, much more muted returns rather than seeing 21% in U.S. small cap growth. The best performing segment was about 4.5. The story is the same. The 12-month returns, partially benefiting from bouncing off the lows of a year ago, partially due to the vaccine rollout. But again, going back to that earlier slide, because the vaccine rollout has been disproportional across the world, their stock markets have been disproportional across the world. So really just an observation. We're not trying to say that, they won't come around and international stocks won't outperform, but, it is a direct correlation that, the better the country can emerge from its health crisis, the more likely their asset values will appreciate, again, due to profitability of the underlying companies. Another aspect of that, or in part of the reason for lower international stock returns in the first quarter, is shown at the bottom of this page. I know it just looks like two squiggly lines, but the bottom of the page shows you that the US dollar appreciated by about 3% versus a basket of global world currencies. And when you consider that a strengthening dollar has a direct negative impact on non-US investments, in particular stocks, then you could see that it has contributed to the performance of our international holdings. So there is a one-to-one correlation there. So if we go back to that 4.5% return that I called out on international stocks, if it weren't for a 3% appreciation in the dollar, then that return would have been commensurately higher. So it does have a direct impact. And the reverse is also true. If and when the dollar declines, then that will be a benefit to the performance of our non-US holdings. So we couldn't talk about the first quarter without at least discussing GameStop. And I happen to have been in a GameStop store with my nephew picking out a couple of video games for his birthday. But to many people, it's just a little video game store that they walk past on their way into Panera. But now it's a company whose stock has had a big impact on their lives, mostly negative, although some people probably did come out ahead by luck. If you don't know the story, it's about a social media chat group that caused retail investors to bid up the price of GameStop, really to stick it to a hedge fund who had shorted the company, basically bet on the price to decline. The surprising thing to us is that, I might use the term a ragtag group of retail investors could move a stock price from about $10 to over $350, back down to $50 and back up to $250. And as Bob alluded to earlier, the lesson here is just don't get caught up in the hype. Who could have predicted the movement in this stock price? And most often, investor behavior is such that the fear of missing out causes you to get in at the wrong time. When the stock price goes up to 350, people are starting to feel euphoric, like the sky's the limit. It's just going to keep going up. We've seen similar themes with Bitcoin and other cryptocurrencies, but that's just not how we invest. We are investors, not speculators. And if you are going to buy a stock or some other asset, we feel like you should always make sure there's a fundamental rationale for owning it and for the price you're going to pay for it. And rather than timing the market, I know this is kind of a cliche now because we use this slide a lot. Instead of timing the market, it's all about your time in the market. And what this slide shows you as you go from left to right, historical returns of the stock market and your experience will depend directly on how long you hold those positions. So going back to before the Great Depression, at the left side of your screen, you see there have only been 25% of the time that a one-year holding period in stocks would have been negative. As you extend your holding period, as you move to the right of the page, if you just hold your stocks for 5 years, you would have only had a negative experience 11% of the time. If it's a 10-year holding period, there have been 6% of the time when returns were negative. But if you had a 15-year holding period, you had never experienced negative returns from the stock market. So the only way you can lock in negative returns is by selling out when there's a decline. So as Bob said earlier, having that fortitude to stick through periods of challenges in stocks in general, or the categories of stocks that you own, has paid off, and we believe will continue to pay off in the future.
Yeah, one other thing I'll make on that, Mario, is, it's a great presentation there to give an example of one asset, the domestic equity market. And a majority of our clients, though, will be anywhere between 40 and 60, maybe 70% equity. And they have the international and they have the bonds. And so these wheels of experiences over different time periods look a lot different, and so that the cycles that our clients will have to experience will be a different, look a little different than what this demonstrates here. So that again is having an investment plan and then sticking with it will help improve the dynamics even more.
Absolutely. Well, I couldn't have wrapped it up any better than that. So that does conclude my prepared remarks. Certainly any questions that viewers have can channel them back towards you, towards their, any other contact at Novi. And if I can help answer them, I'd be happy to do it.
Mario, I appreciate everything you do here, being able to take complex information and distill it in a way that hopefully our clients are able to grasp and understand, and maybe answer any questions they may be having about the headlines that they're seeing as an interim for when we may not be having a conversation with them. And as Mario said, at any point, if this raises more questions or we'd like to have an additional conversation, always we're available. Please feel free to email, call. We can set up a Zoom at any point and phone call, whatever, to go over in more depth. So thank you for your time here, Mario, and giving an excellent presentation an explanation as to what's transpired this past quarter and some things to be just mindful of as we move forward.
Thanks, Bob.
All right. Have a good one.
You too.